Yeah, I mean, silver was really bound to take off. It was near what 90 to 1 with gold, record lows. Gold was marching higher, really from 2000 to 2200, 2300-ish. And silver hadn't even moved. Silver was still below 25. And then all of a sudden it spiked up to 30, pulled back a bit. But I think now silver has broken out and it's joined gold and will ultimately eclipse gold as far as the percentage gains, not the price. But I think, percentage wise, I think that silver could hit $50 an ounce before gold hits 3,000. And so that's a much bigger gain for the price of silver than the price of gold.
This month's surge in gold prices, driven by geopolitical tensions in the Middle East and increased gold reserves by central banks, has set the stage for the precious metal to reclaim new all-time highs, aiming for around $2,430. Despite Federal Reserve Chair Jerome Powell's emphasis on maintaining a restrictive policy framework, traders believe the Fed's reluctance to cut rates further is bearish for gold. However, economist Peter Schiff argues that this belief overlooks the bullish implications of the Fed's stance. Even without rate cuts, the absence of rate hikes can favor gold, especially with rising inflation and indicators like commodity prices and credit growth showing strength. The Fed's rate hikes haven't slowed credit growth, and escalating deficits fuel inflationary pressures. Central banks, particularly those in emerging markets, have been bolstering their gold reserves, signaling their confidence in gold as a hedge against inflation. Statistics from the World Gold Council reveal record net purchases by central banks, doubling the average annual purchases of the previous decade. Amidst this backdrop, silver, previously undervalued compared to gold, has now broken out and is poised to outpace gold in percentage gains. Silver's potential remains significant despite modest gains and holding above $28 for 6 consecutive trading days. Peter Schiff suggests that while gold may reach $3,000, silver could surge to $50 per ounce, offering greater returns. However, silver has historically underperformed due to central banks' preference for gold and retail and institutional investors' lack of understanding of market dynamics. Nonetheless, with gold and silver both showing strong potential for further gains, investors may need to reconsider their asset allocation strategies in light of these developments. We will present clips from Peter Schiff's interview with Commodity Culture, in which he shared his bullish outlook on the gold and silver market. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
We're just getting started. I think there's still a lot of fear and doubt in the market. Just look at the underperformance of the gold and silver mining equities. Traders are, very skeptical of this rally. They didn't expect it. In fact, just a couple of months ago, Newmont Mining and Barrick Gold were basically downgraded to sells, the equivalent, holds by Wall Street because they saw no upside in the price of gold. And that's when gold was around 2,000. We're now around 2,400, 20% increase. That's pretty good upside. And, it's still early in the year. And, it's just that the traders still don't understand it. They think, well, the Fed is going to cut rates fewer times than we thought, or is going to delay the rate cuts. And they think that's bearish for gold. But it's really not bearish because it doesn't even matter if the Fed cuts rates at all. The Fed should be hiking rates, and they're not. And that's what's bullish for gold because inflation is already headed back up. It never got down to 2%. Now it's headed back higher. I think we're going to take out the 9.1% peak from mid-2022. I mean, all the forward-looking indicators, commodity prices, not just gold and silver, but all commodities are showing incredible strength, much more so than we saw in the previous year. Yeah, I mean, silver was really bound to take off. It was near what 90 to 1 with gold, record lows. Gold was marching higher, really from 2000 to 2200, 2300-ish. And silver hadn't even moved. Silver was still below 25. And then all of a sudden it spiked up to 30, pulled back a bit. But I think now silver has broken out and it's joined gold and will ultimately eclipse gold as far as the percentage gains, not the price. but I think, percentage wise, I think that silver could hit $50 an ounce before gold hits 3,000. And so that's a much bigger gain for the price of silver than the price of gold. But again, I think the reason was the central banks. They weren't buying silver. They were just buying gold. And also the central banks aren't investing in the mining stocks. So, it's the retail public and institutions that might have been investing, and they were not. Again, they don't understand it. They think that gold or silver should be going down because it's a soft landing. Everything is great. Buy the Magnificent Seven. And those who are worried, well, they were buying Bitcoin. I think that the launch of these Bitcoin ETFs really, provided that smokescreen, because when everybody should have been talking about gold's rally, they were talking about these Bitcoin ETFs, which were the most successful ETFs as far as how much money went into them. They're not going to be successful from the point of view of the people who were dumb enough to buy them. It's going to be a complete failure. But Wall Street did, sucker in a lot of speculators, so they're making money for now in these ETFs. But I was actually watching during that first month or so we're trading, like there was 1 week where gold went sideways and gold stocks were down like 15%. And it was like, well, what's going on? And I thought, well, maybe people are selling off their gold stocks to buy the Bitcoin ETFs because the money had to come from somewhere. And in fact, all year, we've had record outflows out of GLD, which is the biggest gold ETF, at the same time where gold prices are running up to record highs. And normally it's the opposite. Normally the retailers are chasing a rally. They're not selling into the rally. And so what that tells me is that they've got it wrong. This rally has legs. It has a long way to go. It's not going to be until we have huge inflows from the retail public that we're probably going to get a significant correction. Probably not even a bear market at this stage, but we could have a 5 or 10% correction if the public jumps in. But so far, they're still selling.
Despite the inflationary environment, gold stocks have been somewhat overlooked by investors who may not fully grasp the severity of the inflation threat. While high inflation usually bodes well for gold miners, the rising costs associated with mining operations, such as energy and labor expenses, have put pressure on their profit margins. However, there's been a recent shift in the market dynamics. Gold prices have been rising, outpacing gains in other commodities. Additionally, the dollar has remained strong, further contributing to improved profit margins for many mining companies. This increase in profitability may catch the attention of investors, prompting them to reconsider gold stocks as a potential investment opportunity. Peter Schiff, a prominent figure in the financial world, suggests that investors delve into this sector despite its inherent risks, given its significant potential for gains. He recommends allocating some risk capital to gold stocks through direct investment or by opting for managed funds like Adrian Day's Euro-Pacific Gold Fund, which industry experts manage. As investors become more attuned to the dynamics of inflation and its impact on asset classes, gold stocks may emerge as a compelling investment opportunity for those seeking to diversify their portfolios and hedge against inflationary pressures. Let's get back to the interview.
I think that these stocks are still incredibly cheap. Gold stocks have been the ironic victim of inflation. You would normally think, oh, high inflation, that's good for gold miners. The problem is the investors haven't really recognized how bad the inflation threat is, and they haven't bid up gold prices enough, but the cost of mining has gone up dramatically. Most gold companies are making less money today mining gold at, 2,400 than they were mining it at 500. Because of the increase in energy costs and labor costs. But what nobody seems to notice is that recently now, gold prices are outstripping the gains in a lot of other commodities. And the dollar has stayed firm, meaning the gold price in terms of other currencies has actually risen faster than it has in dollars. And most mining companies, their wages are in those other currencies. So the margins, I think, over the last few months have really improved rather remarkably in these gold stocks. And so I would be looking for that to be reflected in their earnings that come out. And maybe that'll be a catalyst or a wake-up call to Wall Street to buy these stocks. But before they get that wake-up call, while they're still sleeping, I would advise your listeners to be moving heavily into this segment, recognizing it is a risky segment. So, don't put money in there that you absolutely can't afford to lose. But if you do have risk capital, this is what risk capital is for, because the upside potential, I think, dwarfs the downside risk. I think it's a unique opportunity to make, stellar returns. And you can do it yourself, or you can hire me. In fact, I didn't even do it myself. I hired Adrian Day. You've had him on your program. Adrian manages the Europe Pacific Gold Fund. You can buy that no load at any discount brokerage firm. EPGIX, I believe, is the no load symbol. It's the institutional class of the Europe Pacific Gold Fund. I think Adrian has built an incredible portfolio. We've got some really good juniors in there that I think are going to be, the 50, 100 baggers of this bull market. But I think the seniors are still going to go up 10x, before this thing is over. But you can get a lot of exposure if you have a larger portfolio. We have separately managed accounts at Europe Pacific Asset Management. You can visit me at europacfunds.com or europac.com, even shorter, and talk to our representatives there about us managing a portfolio for you in the mining space. We do separately managed accounts. And of course, don't overlook owning the physical metal. I mean, I think there's more upside potential in the miners right now, but of course, there's more risk there as well. But everybody should own some physical gold and silver in particular right now. And you could get that from shiftgold.com. That's my gold company. And I think we've got the best prices and the best service. We've got personal service at discount prices, and we don't push people into numismatics or anything like that. We recognize that you're not buying gold to become a coin collector. I mean, if you're a coin collector, okay, that's totally different. I'm not knocking collecting coins or collecting art or anything else. But if you just want an inflation hedge, if you want to get out of fiat currency and have savings in metal, you don't need to become a coin collector. You just need to buy the most gold and silver you can for your money. And that's with bullion.
The trajectory of gold appears poised for a substantial surge, with predictions indicating a potential 25% increase. This uptick in gold's appeal is fueled by escalating tensions in the Middle East and the anticipation of looser monetary policy, as forecasted by Citi. Meanwhile, the market sentiment towards silver remains bullish for the upcoming week, with silver prices closing near their multi-year high at $29.80. There is considerable potential for significant movements in the silver market in the days ahead. Where are prices heading next? Do tell us in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.